The same is also true in bond markets. You can see that holders of US corporate bonds, the percent of total outstanding, and this is quite an amazing chart. So you can see insurance and pension funds, who are typically long-term holders, they ride out the cycle. Pretty sticky. Their proportion of their holdings of the bond market have gone down from 40% to about 1/4. And mutual funds, ETFs, and households now own a lot more of the bond market. Should we worry? Isn't this just a good sign of disintermediation in the financial system? Well, to some extent, yes. But there is also a problem with this, because what we've also seen is during periods of volatility when bond yields start to rise, which they surely will over the next few years, these mutual fund investors are typically the first guys to head for the exit. They're very, very flighty. And this money tends to push out very, very quickly at the first sign of volatility. Now, you've started to see a debate within policy circles about how regulators and central banks can do this. You may have seen some news stories about the Fed considering exit fees on bonds, on bond funds. At the moment, we know there's a very active debate within the Federal Reserve, as there is in the IMF, about whether that's a good thing or a bad thing. A couple of recent Fed papers have suggested that imposing exit fees on bond funds would actually precipitate the run rather than prevent it. So this is not a closed question, and it's going to be interesting to see what how the US deals with this over the next few years. Just to wrap up on the US, I'm not really going to spend too much time on this. One can think of lots of different scenarios in which you would get a very messy situation in bond markets, in emerging markets, and that's typically if the Fed were to hike rates quicker and sooner than people expect. And we have various yield curve models. I'm sure some of you guys have probably seen these before, run them yourself. The impact on the US Treasury 10-year can be quite significant. So if you do get a much quicker pace of Fed rate hikes than anticipated, the impact on treasuries can be quite big. At the moment, the market, as the way we understand it, is pricing in, starting the middle of next year, a 25 basis point hike at every other FOMC meeting. Now, if you go back in history and you look at cycles of Fed tightening, it is really rare to find the Fed hiking 25 basis points every other meeting. So there's a lot of good news already priced in, we think, into the curve. At the moment, this scenario is given by markets a roughly 10% probability. So if that balance shifts, then we might start to see some volatility coming through. I'm not going to touch on this, but suffice it to say, when you do get volatility in US bond markets, it spills over very quickly to global markets, both advanced economies, the Euro area, the UK, to a lesser extent Japan, but certainly emerging markets. Okay, well, I'm going to spend a little bit more time now on emerging markets and what this means for emerging markets and how they're placed and what this wave of global liquidity has done in this part of the world. You can see that there are many different ways of trying to estimate how big the wave of global liquidity into emerging markets has been. This is hugely controversial, and people get quite upset, particularly officials from emerging markets themselves when they see this chart. So we normally get a reaction. What we try and do here is just give a sense as how much excess money has gone into emerging markets over the last few years because of QE. And one way you can do this, not the only way, of course, is if you look at bond flows from advanced markets to emerging markets, and you look at the pre-crisis trend, so we're on this line, extend that trend out to the end of 2013, the blue line is the actual flow from advanced markets to emerging markets. You can see the gap is about $500 billion US. That's just in bonds. That just gives you one indication of how much money might have come into emerging markets simply because of QE and very unconventional monetary policy in advanced economies. Now, of course, the risk is that at some point this starts to flow back out again and we start to go back to the pre-crisis trend. And that's quite a lot of money. How might it come out? Again, I think it's interesting to think about different types of investors. Over the last 12 months or so, during periods of volatility, when we have seen money come out, institutional investors have not been selling as far as we understand. So to a very large extent, the red line here just looks at total flows into emerging markets. They have been pretty stable. The people that have been selling have been the retail guys, the mutual funds and the ETFs. Clearly, they could keep on selling. At the moment, they're not, but if they started selling again, you saw how much volatility that created in some emerging markets earlier. The risk is, of course, if some of the institutions try and get out as well. And this is very, very large amounts of money trying to get through a very, very small exit. What sort of things should we think about when we're considering the risks across countries in an environment in which, for example, US interest rates start to go up, perhaps unexpectedly quickly? Well, one way to think about it is the two factors that drove the weakness in some big emerging markets last year. The first one is current account balances or external deficits. So how much do these countries have to borrow on global financial markets to fund themselves? And you can see current account balance as a percent of GDP, our forecasts for the end of this year from our country teams. You see that, and here on this axis is just where 2-year real interest rates are relative to the average over 2003 and 2008. So basically this is the difference in compensation that people who are funding the current account are getting now relative to what they were getting 5 or 6 years ago. So really the point of vulnerability is in this quadrant here. Turkey, South Africa, Brazil, Indonesia, and India. So that's the fragile 5 right there. The markets that did okay, that were much more robust, you can see typically had either pretty decent current account balances or where real interest rates have already adjusted to some extent. The other factor, it wasn't just external imbalances, was inflation. So how much had these countries been pushing domestic demand too quickly, and inflation had picked up, which meant that when the currency started depreciating, these countries had to raise interest rates, and that has all sorts of damaging effects on the domestic economy. Well, here you can see inflation, our forecast, end of this year, minus the country's own inflation target. So the further you are over here, the bigger the inflation problem that you have. And then you can look on this axis, how much rate tightening is priced in. So up in this quadrant is where you have a problem. Turkey, South Africa, and Brazil. So current account balances and inflation relative to target. Those are the two variables that drove the weakness through much of last year. Are we saying that emerging markets are on the verge of a 1990s style collapse? Well, clearly the answer is no, because if you look at where we are now relative to the late 90s, there are some very big differences. First of all, reserves are much higher. So these countries have much more firepower to defend the exchange rate if it starts to come under pressure. And the other factor that's very supportive for some emerging markets, at least, is that currencies are now flexible. They can let the currency depreciate. Previously, in the 1990s, you can think about all of those fixed exchange rate regimes, which were very inflexible. And so the thing that had to move were interest rates. And that was much more damaging to the financial sector and to the domestic economy. So this time, there are much bigger shock absorbers. And you can see that here. Reserves as a percent of external financing requirements, typically that number is much bigger than 1 for some of the bigger emerging markets. Where we do have concerns, again, it's the same old culprits: South Africa, Turkey, Argentina, to some extent Indonesia. I've got 5 minutes left, so let me just briefly finish on one final aspect of what's been going on in emerging markets. Where has all this money been going? This big wall of money that's gone into emerging markets, that's pushed out current account deficits, that's raising inflation. Well, a lot of it is not going to governments, like we've seen in previous cycles. It's being borrowed by firms. So if you look at the net new issuance of emerging market bonds over the last few years, the blue bar is sovereigns, governments. They haven't really been borrowing externally. It's firms that have been borrowing externally. And this has created quite a big change in what we call corporate vulnerabilities. So a lot of firms in emerging markets now are more highly leveraged. So here we have a measure of debt coverage, if you like, or debt to earnings. So the higher the number, the greater the level of debt relative to the firm's earnings capacity or debt service capacity. on the bottom axis, 2008. This axis, 2012. All of these emerging markets have basically shifted up, or the vast majority of them. The markets that give us where you've seen the biggest changes, China, India, and to some extent Chile. What's really interesting is that this has been an environment in which interest rates have been very low globally. And you can issue bonds now at a very narrow spread over swaps or the 10-year treasury in US dollars if you're a reasonably large corporate in any of the major emerging markets. And yet at the same time, the growth rate of interest expense has been rising significantly. So for these emerging markets, unfortunately we have data, when we did this work, we only had data up till 2012. The problem with emerging markets firms is there isn't much data. And so you have to use, in some cases, numbers that are quite out of date. We've updated this up till 2013 and the numbers aren't particularly different. But here we're looking at a sample of about 15,000 emerging market firms in 19 different countries, both listed and non-listed. And the key message here is that if you look at the growth rates of interest expense for this sample of companies, it's been growing in many cases above 20% year on year, much quicker than the pace of earnings. So what that has meant, of course, is that debt service capacity has been going down. So what we looked at was a sensitivity analysis. What would happen if things change? How vulnerable are firms in these markets to a change in financial conditions or to some sort of economic slowdown? In this chart here, we look at what's called debt at risk. These numbers here refer to interest cover ratios. So how much can a firm's earnings cover its own interest bill? So if it's 1 and below, it means that earnings can't even meet its own interest payments. Between 2 and 3, it means earnings are 2 to 3 times the interest bill. Okay? So obviously the lower the number, the more vulnerable a firm is. And what we've done is we've looked at the current distribution across these emerging markets. So just to give you an interpretation, for example, let's look at China. The proportion of debt at risk, the amount of corporate debt in China, at least for the listed sector, that is owed by companies with an earnings coverage ratio of 1 and below is about 15%. It's a pretty big number. And then you can see the rest of the distribution, at least up till here. So what we did is we tried to understand what would happen if we saw a simultaneous increase in interest expense of about 25%. So let's imagine that your interest rate goes up from 10, for example, to 12.5, and you see earnings decline at the same time by 25%. Now, we didn't pick these numbers out of the air. That was actually what happened during the Lehman crisis. So this is a calibrated shock. And then we looked at what would happen to the proportion of firms that had an interest coverage ratio of less than 2. So that's up to the yellow bar here. And what you can see is the change is between the yellow bar and the black dot. And the black dot is the proportion of debt at risk in those economies that is owed by firms after the stress that I've just applied of less than 2. And you can see in some very large emerging markets, India, Indonesia, China, Brazil, South Africa, Philippines, and Turkey, that number goes to close to 50%. So 50% of total corporate debt would be owed by firms with very, very weak debt servicing capacity.